top story now. The Federal Reserve has raised interest rates for the 7th time this year.
However, this latest hike is slightly lower, if that's any consolation, than the last several increases. The central bank boosted its benchmark interest rate by 0.5 percentage point. The past 4 rate hikes were 0.75 percentage point. Today's announcement comes just one day after the latest Consumer Price Index report showed prices rose less than expected last month. Fed Chair Jerome Powell says there is more work to be done, though, to ease inflation.
Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Joining us now is CBS News Chief White House Correspondent Nancy Cordes, CBS News contributor and Axios Managing Editor of Business and Markets Javier David, and host for financial news website The Street, J.D. Durkin. I want to jump over to Nancy right now. How do you expect the White House to respond to the Fed doing what we expected them to do? Has there been any word that you've seen? And obviously, this is breaking news, and it just happened right now. But tell us what the White House feels, especially given that they don't have any control over this.
Right. So this is one of those pieces of economic news that the White House tends not to react to because they are so eager to show that they have no influence on the Fed and that they are not trying to push the Fed in any particular direction. So we don't expect any kind of a statement from the White House that would track with the previous 6 rate hikes that we've seen from the Fed this year. The White House did do some celebrating yesterday after we got news that inflation was actually a little bit lower this past month than expected, but still a healthy 7.1%. The administration would like to see that closer to 2%. And so I think everyone here is well aware that while this rate hike is a little smaller than the previous ones that we've seen, that the Fed is likely to continue raising rates into the new year, at least a bit, before there is any hope that the Fed would begin to reverse that. And that's well understood because a reversal could potentially trigger inflation to fire back up again. We've seen that happen before, where everyone thought that inflation had peaked earlier in 2022, and then it came roaring right back. So some cautious optimism here from the White House about the new inflation numbers. But the reality is some prices really didn't come down very much, particularly when you're talking about food. When you're talking about rent, the kinds of things that people pay every week or every month.
Yeah, and the fact of the matter is this news impacts all of us, everybody watching, everybody we know. If you're just joining us here on CBS News, the Federal Reserve has announced a 50 basis points increase to interest rates. We're speaking with Nancy Cordes, our Chief White House Correspondent. We've got Axios Managing Editor of Business and Markets, Javier David. And now let's bring in host for financial news website The Street, J.D. Durkin. You're there on the stock exchange, where if we pull up an image of the big board, J.D., while the markets had spent most of the day in the green, at the very end, which is just the past few minutes, you've seen it reverse itself and pull into the red, despite the fact that this is what we've expected. How are you interpreting, how Wall Street is interpreting this news?
I think investors are simply trying to allow the dust to settle. This is the ultimate seesaw day. Let's be honest. Every time the Fed has a decision like this, if you hear more dovish sentiment, you react one way. If you're looking for more hawkish sentiment, you react the other. Now, the major market indexes have been trading up in the green throughout today's trading session. In fact, just a few moments before we joined you here on air, we had both the Dow and S&P were up as high as about 7 or 0.8%. That's clearly not the indication right now. There is going to be some interesting elements that happen later on. Of course, at 2 o'clock, we just had this announcement that's sort of the first tranche of information investors react to. The next one is the 2:30 p.m. or so press conference, but mainly Chairman Jay Powell's comments, which are very carefully scripted, uses very careful language. And then the third tranche of information, I would argue, is that really interesting question and answer period when Jay Powell is forced to be off script. Those tend to be the three things I notice on Fed days investors pay close attention to. This obviously is the reaction here. And thank you, by the way, for putting this up on the screen so I don't have to crane my neck to look up at the big board here on the floor of the stock exchange. But you'll hear a lot of commotion behind me. Of course, this is understandably the top story in the world of business today. And we will continue to see how investors react as the dust continues to settle on this trading Wednesday.
Absolutely. And we can see, as we continue to reference our big board, that after that initial drop, that sudden drop, we've seen it's sort of inching up a little bit, though it is still in red. Javier, let's talk about the fact that this is the last interest rate hike of the year. JD, as you heard, said we get always an indication of where the Fed may head next in that question and answer period that follows. But talk to us about what extent the rate hikes have been affecting the economy and what this announcement, the 50 basis point addition, means for the U.S. economy. Should Americans be concerned at all about this? Obviously, anybody with credit card debt or looking to buy a home or making a big purchase, they're going to be feeling the effects of this.
Yeah, let me back into it by addressing something that Nancy said. The White House is not going to comment, of course, on monetary policy moves. But what they have come up with over the last several weeks and months is sort of a mantra. They want slow, steady growth. So they know that the economy is slowing down. They know the Fed is going to continue to raise hikes until it sees fit not to do so. But they want for people to continue to have jobs. They want for people to continue spending. Our consumer spending is 2/3 of this economy that we, talk about endlessly. And what the Fed is trying to do is sort of stick the landing with inflation. They do not want to stop until they feel that the job is done. That is going to entail some pain. They want fewer jobs. This economy has been churning out jobs at an absolutely breathtaking rate. It's come off some, but the bottom line is this is not an economy or a jobs market that is consistent with an economy that's slowing down. So what the Fed wants to do is slower jobs. That is going to entail some pain, and pain means if you're paying a credit card, you're more than likely going to be paying a higher APR. And that will be the case until the Fed sees its, way to pivot, and a pivot could look like a pause sometime next year. That could happen early next year. And what the market really wants is for the Fed to say either we're done or we're going to sort of back it up, put it in reverse, and start cutting rates. We're not at that point yet, but the market would absolutely love to see that. And that may very well happen next year if growth sort of collapses or falls off a cliff.
Great detail there. Please stop carrying credit card debt if you can, from Javier David. I mispronounced your name earlier. Apologies for that. Nancy, on Javier's point then, what does this do to the White House, the administration's outlook for 2023? If we're trying to stick this landing, if we're trying to cool the economy slowly, my opinion of every politician is what they care about most is re-election. How does this factor into President Biden's re-election plan, his re-election message, as that gears up next year?
Well, certainly the White House is hoping that the economy stays strong in the areas where it's strong and improves in the areas where it's struggling, because that gives him the most potent re-election message. Beyond that, if the Biden administration wants to do any new spending in 2023, when it's going to be faced with a Republican-led House for the first time for President Biden, it's going to be an awful hard sell if inflation continues to be as high as it is, because Republicans will inevitably make the argument that that is only going to exacerbate inflation. And why would you pump more money into the economy at a time like this? So if inflation continues to recede, that is going to give the Biden administration a little more juice, a little more ammunition when they go to Congress with hat in hand asking for more money for this particular incentive or that particular priority. Doesn't mean that they're going to get that money, because they have very different priorities than House Republicans do. But it just makes the job that much more difficult for them, makes it a much harder sell with not just Congress, but with the public when inflation is as high as it is right now.
I want to check back in with JD there on the street. JD, we're watching the board. We're hearing about the prognosis for our nation's economy. Does the fact that this rate hike, it's less aggressive than the previous 6 that we've had, does that mean that investors and business owners should be optimistic about the future? Does that say to you that we are starting to head into the potential for a soft landing that the Fed had really been hoping for?
I think at least the potential, but I also would be very quick to stress that Fed Chair Jay Powell has been very quick to say the pace of rate hikes arguably is not as important as the ultimate terminal rate or the final resting place when he's done with, when he and his colleagues are finished with the rate hiking cycle, as well as how long they stay there for. So, you know, there's a lot of people I've spoken to here on Wall Street the last few weeks who have said whether it's 50 or it's 75, what matters is where things settle when the dust clears well into next year. With regards to optimism, I mean, it's a matter of who you ask. I think there's always room for optimism. I've spoken with a lot of portfolio managers who tell their clients to lean into some recession-proof stocks. Just want to be clear here, I'm not a financial advisor, simply a financial journalist. But, you know, I think there's remarkable and tremendous elasticity in the markets. Investors will find new names to put their money into. Of course, the same stocks that saw tremendous growth during the depths of the COVID pandemic are not likely to face the same levels of tremendous growth here in a recessionary environment moving forward here. But with regards to, you know, expectations to how it's going to go here, you ask 10 different people, you will likely get 10 different answers about how this whole thing will play out and where the optimism is to be found moving forward. But I suspect people will certainly try very hard to find that optimism, even in a bit of a dismal economy.
I've once heard that if you ask 5 economists their opinion, you'll get 10 different ones.
Right. Well, look, if JD,
I like that one, yeah.
If JD says optimism depends on who you ask, Javier, I'm asking you, how optimistic are you about things being more comfortable for Americans financially in 2023, based on what we know today?
I am slightly pessimistic. I wish I could be the bearer of good news here.
Yeah, no.
I do believe that this economy is facing entirely too many headwinds and not enough sort of tailwinds, you know, to give it momentum. I do believe that interest rates at this level aren't really the problem. It's really the fact that prices are, while moderating, are still on the rise. I do believe that consumers, in order to navigate this higher inflationary environment that we haven't felt in at least 40 years or so, are leaning more on credit cards, and they're not processing the ways in which that will catch up to them and get incrementally more expensive. And when the bills start coming due next year, I do believe there's going to be a little bit of sticker shock.
You know, Javier, on that front, on the uncertainty that most people are feeling, part of that uncertainty is about the job market. And we've seen some layoffs in a lot of companies. Do you think that that will abate now? Or are we prepared for more of those?
Yeah, I mean, you have to be braced for a job market that is weaker. And I say weaker because it's relative. What we've seen over the last year has been nothing short of extraordinary. It's an economy that just won't stop producing jobs. And a big part of that is because consumers continue to spend, and there still continues to be significant demand in the economy. So what all of that means is next year, we'll start seeing a lot more people, not a lot more people, but a lot more positions just kind of rolling off. Because the truth of the matter is employers still have need for bodies, and a lot of them are reluctant to sort of do what they usually do in business cycles, which is, you know, the hiring and firing. They don't want to fire because you have a hard time hiring people. So you had a lot of positions that are open. Some of them will just roll off quietly and they won't fill them. But I don't believe that we're going to see widespread layoffs. You're just going to see a job market that's going to start to normalize, but still be able to offer people jobs. People are leaving jobs and they're finding new ones. And that's actually a good thing.
Yeah, I know it's unintentional, but I think that's why we all wore blue today. Okay. Javier,
I predicted the stock market, though.
You know, and she's wearing red, and it's in red. Javier David, Nancy Cordes, and J.D. Durkin, thank you very much for speaking with us about this.
Yep.